Hello and welcome. In this lecture video, we're going to be talking about bank reconciliations, okay? So starting on page 158 of your course pack, it says here usually once a month, the bank is going to send the depositor, which would be the company. So we're the company, so the bank is going to send us a bank statement that shows us our monthly banking activity, okay? More and more, this is online, right? But I still get some bank statements from my bank. Okay, so and what this bank statement is going to show us, it's going to show us for a given period, typically a month, right? And so it's going to say, here's your beginning balance in cash. Here's any checks and other debits that decrease the amount, okay? And then it's going to show any deposits and other credits that increase the account. And then it's going to show us our end of period balance. So if we look over here, we have our previous balance, which would be our beginning, plus any checks and then debits. This is any cash disbursements, like less any cash disbursements, plus our deposits equals our current balance, okay? And then we would have our, as you can see right over here, we have all of our checks, our specific checks. So for example, on 10/3, check number 119 in the amount of $55. On date November 9th, check 120 in the amount of $200. And then we have our deposits on 10/2, the amount of $240, 10/9, $180, and electronic funds transfer. And then which shows us our daily balance right over there. Okay. Now, I was saying, and this could be confusing to you, that checks and other debits decrease our account. So basically, when we have a cash disbursement, the bank sees that as a debit. Well, that doesn't make sense, right? Because a debit to cash means the cash is going up. And then when we deposit money in our bank account, the bank treats that as a credit. Well, that doesn't make sense because cash is credited when it goes down. So what we're seeing here is the reverse. And here's why it's the reverse. It's because the bank statement is from the bank's perspective, not your perspective. Okay? You being the company. It's not, or even your personal bank account. It's not from your perspective. It's from the bank's perspective. And from the bank's perspective, go on to the next page here, the depositor's account is a liability to the bank. So when you deposit money in your bank account, from the bank's perspective, that deposit is a liability. So as you deposit more money, their liability to you goes up. Okay? So the way the bank records that you've deposited money is they're going to debit their cash and credit a demand deposit liability or some name similar to that reflects your deposit. So they will credit a liability and then debit cash. So debit cash and credit a liability. Okay? That's why it's the reverse of what we've been talking about, because it's not from your perspective, it's from the bank's perspective. Okay? And so debit memos produce credits on the depositor's books. Okay? Credit memos produce debits on the depositor's books. And so we're the deposits. We're the depositor. Banks also include canceled checks. So those are the checks that have already been cashed and deducted from our account over the accounting period. And then there's also other deductions on the bank statement that maybe we haven't even considered yet, such as service charges and fees, and then corrections of previous errors. So when we talk about what a bank reconciliation is, it's a report that explains differences between the balance in your checking account, right, which is on the bank statement, and then the balance in cash in the general ledger. So there are differences, and I'm going to say that again. We can see that with this figure here on page 159. We have our bank balance, which is how much the bank says we have in our checking account. And then we have our book balance, and this book balance right over here is our cash account in the general ledger. And there are differences. There can be differences. Okay? And so what we do in the bank reconciliation is to go through and say, here's our bank balance, and we're going to add and subtract any timing differences or any errors. And then we have our book balance, and then we'll add or subtract any timing differences and any errors, and then we have our adjusted bank balance, and that should equal our adjusted book balance. And to get to our adjusted book balance over here in terms of the general ledger, we may have to do some journal entries. Okay, now let's talk about why it is that the balance in our checking account can be different from the balance in our general ledger. It's rarely going to be the same. Why is that? We have some factors here on this next page that explain differences. We can have some outstanding checks, which would be checks written by the depositor and deducted from the depositor's records and sent to the payee, but not yet received by the bank for payment. Okay, so some checks that have not yet been received by the bank for payment by the bank statement date, so that's the timing difference. Outstanding checks. Deposits in transit. So we can have a deposit that we've made, right? So we've recorded that in our general ledger, but it doesn't show up yet on the bank statement. Okay, maybe that deposit was made at the end of the business day, so we debited cash, right? So our general ledger shows cash going up, but it's not yet reflected in the bank statement. So it's a timing difference. We can also have some deductions for uncollectible items and for services. We can have non-sufficient funds, for example. So in that case, the bank would have initially credited our account, but when we have non-sufficient funds, right, the bank is going to debit the depositor's account and then could also charge a non-sufficient funds fee. Okay, and then it's also going to send us a debit memorandum. Okay, we can also have some additions for interest and other collections. So the bank may collect on a note or receive electronic funds transfers. Sorry, I was looking at errors there. We can also have some errors that would explain some differences between the bank statement and then the depositor's records. Okay. So at the top here, we have this figure. We have a reconciling item, outstanding checks. That's already been subtracted from our general ledger. And then it could be included in our bank reconciliation as subtracted from the bank balance. Deposits in transit, added to our book balance, and then added to our bank balance. Bank fees subtracted from our bank, and then we'll have to subtract that from our book balance. Non-sufficient funds would be subtracted from our bank, and then we would then have to subtract that from our book balance. Interest earned, that would be added to our bank balance, and then we would have to then add that to our book balance. So if we look over here, and we look at our bank reconciliation example, see? We have our bank statement balance, and then we have our book balance. So the way we'd want to do this is do like two columns. One for our bank statement balance, and then one from our book balance. And our book balance of 1404 right over here, 58, we get that from the general ledger. And then with our bank statement, we'd say, well, we have a deposit in transit. So if we look at that deposit in transit up here, it was added to our book balance, and now what we have to do is add that to our bank balance. And then what we have are some outstanding checks. Those have already been factored into this book balance, but they haven't been factored yet into our bank balance. So it's been subtracted. Now we need to subtract it from our bank balance. So that's where we get this check number 124, 150, check number 126, 200 subtracted. And we have the total, and then we say, we take our bank statement plus our deposit in transit, gives us the 2,195 minus the 350 right over here of outstanding checks, gives us our adjusted book bank balance of 1845. And then we look at our book balance. We started with 1404.58, which we pulled from our general ledger. And then what we had is the bank said we had this collect on $500 note less $15 fee. That's $485. That's something that we haven't recorded, but the bank has done that for us. So that number is included in here in our bank statement, but it's not yet included in our general ledger. So we have to add that. Okay. And then we also add interest earned. That has been added to our bank balance. And so now we have to add that to our book balance. And then we can deduct our check printing charge. Okay. We have not recorded that yet. So that's not yet recorded in our book balance. So we would deduct that. And then we also have a non-sufficient funds charge, right? One of our customers paid us with check and they didn't have enough money in their bank account. So we have a non-sufficient funds and then plus a service fee of $30. So we have our book balance of $1404.58 plus our note receivable plus our interest earned gives us our $18.98 minus our check printing charge of $23 and our non-sufficient funds plus our service fee of $30 gives us then our adjusted book balance of $18.45, and then you can see that is reconciled with our adjusted bank balance. Okay, so as we can see up here in the figure, and then I've written out here in terms of our steps in our reconciliation, we will first, I'll go through these steps and then relate them to the figure, which will be a little bit of a repeat of what I just talked about, but I think that's still good. That repetition is good. So we identify our bank statement balance in the cash account right over here, which is from our checking account. We get that $2,050 from our bank statement. Then we identify and list any recorded deposits and any bank errors, and then we add these to our bank balance. That's the $145. So that's step 2. Identify and list any outstanding checks and bank errors that overstate the bank balance and then deduct those. Here's our outstanding checks, and so they are deducted to get to our adjusted bank balance. Okay, and then step 4, compute the adjusted bank balance, and that's our $18.45 right there. Step 5, identify the company's balance in cash. That's right up here, $1404.58. Where do we get that from? The general ledger. Step 6, identify and list any unrecorded credit memorandum. So the bank collected a note receivable and then interest, and that's right over here. They collected on a note receipt. The bank collected a note receivable for us, and we didn't know that. We only got that because we looked at the bank statement and said, oh, they collected on a note for us. Thanks. That's how they told us. Okay, at 45, and then they also gave us interest. And then as you can see here, we add them to the book balance. Step 7, identify and list any unrecorded debit memorandum. So our non-sufficient funds and check printing fees. So we would get these from our bank statement. We say, oh, they charge us for a check printing fee. We have to deduct that from our general ledger book balance. And then we would then compute our adjusted book balance, and then we would verify that those two are the same, and that's the process of reconciliation. Now, when you look over here at these adjustments to our book balance, we have to do journal entries, right? Here we have to debit cash, here we have to credit cash, okay? So we have to do some journal entries to get our book balance in the general ledger equal to our adjusted book balance, which is the same as our adjusted bank balance. And let's look at those journal entries. So the first one, we debit cash for the $485, and then we have our $15 collection expense. We can see that here, less our $15 fee. Okay, so debit cash $45, debit collection expense $15, and then credit our notes receivable for $500 because we were told that the bank collected on our notes receivable. And then what we have is our interest earned, debit cash, credit interest revenue, and again we got that from our bank statement. And then what we have also is our miscellaneous expenses, 23, debit miscellaneous expenses for 23, credit cash for 23. Okay, and then again we got that from our bank statement. We would see that in our bank statement. And then the last one is we have our non-sufficient funds. It says right over here, our $20 check originally received from a customer, right? The bank tried to cash that, and then they were told that the customer didn't have enough money. That's what happened. So then the bank charges us a $10 non-sufficient fee, and then deducts $30 from our account. Okay? So that's a $20 check plus the non-sufficient funds fee. So that's why we debit accounts receivable and then we credit cash. So credit cash reduces our cash, and then we debit accounts receivable. And look at the debit accounts receivable for $30. That's the original $20 receivable, plus now we're going to charge them from the non-sufficient funds fee. So we're adding that to accounts receivable from T. Woods, and we're saying, Mr. and Mrs. Woods, you owe us now $30. You used to owe us $20, but now you owe us $30 because of this $10 non-sufficient funds fee. Okay? Thanks so much.